waiting is over. The Federal Reserve did not raise rates, but the press conference does reveal some interesting details from time to time. So we're diving into that with Rob Pemberton, head of fixed income at TD Asset Management. Hello, Rob. Well, let's start off with why this decision.
At this stage, the Fed doesn't believe that they are going to meet all of their objectives if they raise interest rates in the current environment. What we've seen is a change in their statement indicating concerns about the path of inflation as well as changes to the global economic outcome.
So this is a little bit more negative maybe than before?
We would say that this was a more dovish, and by dovish what we mean is a note or meeting that indicates that they're not concerned about the growth path being too great in the current environment.
So when do you think they're going to raise rates?
Well, I thought they would do it today. They had a window of opportunity. Unemployment in the U.S. is now at 5.1%. They've been growing. The U.S. market has been growing 3 million jobs a year since we've come out of the recession. And we continue to see progress made on the non-commodity-based manufacturing side. So those components seem to add up to the possibility that the Fed would take the opportunity today to raise interest rates for the first time. Now, also, I want to make it clear that even if the Fed had raised rates, they would have gone from 0 to 25 basis points to 25 to 50 basis points, which is not restrictive monetary policy from the perspective of the markets. And when looking at it from through that lens, what we really see is a Fed who's more concerned about global developments and not being able to meet their inflationary objectives over the near to medium term.
So what does this say about the path of interest rates from now on? Are you still expecting something to happen before the end of the year?
My next best estimate on when the Fed would be prepared to move would be the December meeting. And irrespective of whether they go in December, October, or even if they had gone today, my expectations would still have been that it would have been the loosest tightening of monetary policy cycle that we've ever seen from the Federal Reserve. And in my mind, it's more about the path and how gradually that path is going to increase over time, given the data dependency that the Fed is looking at going forward.
So it looks like they've just kicked the can down the road a little bit further?
That would be a great way of characterizing it. And from our perspective, we don't see this materially changing how investors should be thinking about their long-term outcomes. We're still thinking that fixed income overall is going to produce mid-single-digit returns over the next 3 to 5 years, and that we will see muted returns from the equity space, call it, mid-single digits, 6-7%. And as a result, investors will still be able to see that type of return structure irrespective of the Fed's actions today.
All right, thank you, Rob. I've been joined by Rob Pemberton, head of fixed income at TD Asset Management. I'm MaryAnn. Thanks for watching.